All right, let's get right into it. Picture this. It's salary day. The money finally hits your bank account. And right behind it, that little wave of anxiety. That feeling that you should be doing something smart with it. But then the noise starts. Buy this mutual fund. You have to save tax. No, gold is the future. It's a lot. And that confusion, it's something pretty much all of us feel.
And so, what happens when we're that overwhelmed? Well, for most of us, it's one of two things. Either we freeze up, analysis paralysis, and just end up doing nothing at all, or we make some small, random investment, kind of just to feel like we've ticked a box. But both of these are just symptoms of the exact same problem. We don't have a clear step-by-step plan.
And this is where things get really, really interesting. There's a huge paradox happening in India right now. On one hand, we're starting SIPs, systematic investment plans, at a record-breaking pace. I mean, the whole mutual fund industry is just exploding. But, and this is a huge but, on the other hand, we're stopping them just as quickly.
Now get this. This is not an exaggeration. The data is kind of shocking. In a recent month, the SIP stoppage ratio actually hit 100%. Just let that sink in for a second. For every single new investment plan that was started, another one was completely canceled. We are jumping into the pool with all this excitement and then immediately scrambling to get out. This isn't a problem with the investments themselves. It's a problem with our foundation.
And this quote just hits the nail on the head. The reason people are quitting is because they're building their financial house in the completely wrong order. You see, they're buying the fancy, exciting mutual funds, that's the roof, before they've built the solid, maybe a little boring, walls that can actually hold it up. So when life happens, a job loss, a medical emergency, or the market just dips, the whole thing comes crashing down. Well, today, we're going to fix that.
So here's our game plan. We'll start by digging into this paradox. Then I'm going to show you a super simple but powerful framework, the financial pyramid. We'll go through it level by level, starting with your defenses, then investing with purpose, and finally reaching the compounding endgame. And we'll wrap it all up with a clear action plan you can start using right away.
So, this is it. This is the elegant solution to all that financial chaos. It's the financial pyramid, and think of it as your step-by-step guide to getting your money in order. The logic is simple, and honestly, it's non-negotiable. You start at the bottom, and you absolutely cannot move to the next level until the one below it is rock solid.
And you can see the sequence right here. Level 1, you clear out that toxic, high-interest debt. Level 2, you build your emergency safety net. Only after those two are done do you move up to maximizing free money, then investing for your specific goals, and finally, way at the top, building that long-term wealth. So let's start where we have to, at the very foundation. All right, we're kicking things off with the two most important non-negotiable steps. And listen, these first two levels aren't about getting rich. They're about making sure you don't get poor. This is all about building your financial defense system. So before you even think about investing one single rupee, you have to get rid of high-interest debt. Just look at the math here. Your credit card is probably charging you around 36% interest a year. That's a guaranteed 36% loss. Meanwhile, the stock market might give you 12% in a good year. So if you invest while you're in credit card debt, you're literally choosing a guaranteed massive loss over a potential small gain. It just doesn't make sense. Paying off that debt is the best risk-free investment you will ever make, period. Okay, next defensive wall, the emergency fund. And let me be crystal clear about this. This is not an investment. Say it with me. Not an investment. It's insurance. It's basically a boring pile of cash, about 3 to 6 months of your total expenses, that just sits in a safe place like a liquid fund or high-yield savings account. Its only job is to be the bodyguard for your real investments. When the market tanks and you suddenly lose your job, this fund is what stops you from panic selling everything at the absolute worst time. It's your financial firewall. Okay, defenses are up. The foundation is solid. Now we get to have some fun. Now we go on offense. This is where we start to proactively grow our money. But, and this is key, we do it with a very clear purpose. You know what's crazy? So many salaried people just leave free money sitting on the table. Think about it. Your employer matches your 12% EPF contribution. That's a 100% return on your money on day one. You literally cannot beat that. Same goes for NPS contributions they might offer. And just choosing the right tax regime can save you thousands upon thousands. This level isn't about finding some magical stock. It's about systematically taking the money that is already yours for the taking. So once you've grabbed all that free money, you start investing for your specific goals. And the golden rule here is that your investment has to match your timeline. It's like having 3 different buckets.
For short-term goals, like a vacation in the next 1 to 3 years, you need safe, low-risk options, like debt funds. For midterm goals, like a down payment in 3 to 7 years, you can take a little more risk with hybrid funds. And only for your long-term goals, stuff that's 7 or more years away, should you be in aggressive investments like equities.
And I love this analogy. Think of your money as a seed. If you need a small plant in a few months, you put the seed in a safe pot indoors, right? But if you want to grow a giant tree that'll be there for decades, you have to plant it outside in a big field. The mistake so many people make is taking their short-term pot money and planting it outside in the middle of a market storm, hoping it survives. Matching your money to your timeline is everything.
All right, we've climbed the pyramid, and now we're at the top. This is the end game. This is where real, life-changing wealth is built. But this level has a secret password, and it's not be a genius or pick the perfect stock. The password is patience. And as we saw at the very beginning, that's a test a whole lot of people are failing right now. Let's look at the actual cost of being impatient. So imagine you start a simple 5,000 rupiah SIP every month when you're 25. If you just stick with it and let it run until you're 60, you'd end up with about 3.25 crores. Pretty amazing, right? But what if you do what so many people are doing and you stop adding money after just 10 years? Even if you leave that initial pot of money to grow, you'd only end up with 2.3 crores. You quit contributing and it costs you a fortune. That's almost 1 crore rupees, just gone, vanished from your future. Not because you picked a bad fund, not because the market crashed. It's gone simply because you got impatient and stopped feeding the machine. You broke the chain of compounding. This number, right here, this is the true price of that 100% SIP stoppage ratio we talked about. This is the cost of quitting. So how do you make sure you don't quit? You build a plan that's simple, effective, and frankly, a little bit boring. For most of us, a structure like this works wonders. You have a solid 70% core in a low-cost Nifty 50 index fund, then a 20% satellite portion in an active fund for a little extra kick, and finally 10% in an international fund to diversify. That's it. It's simple, it's diversified, and it's built to last for the long haul. Oh, and a quick word on all the other stuff you hear about. Direct stocks, REITs, gold, whatever is new and exciting. I call these wealth accelerators. Think of them like a turbocharger on a car. It can make a fast car go way faster, but what happens if you try to bolt a turbo onto a car that doesn't have an engine? Yeah, it's just a heavy, useless piece of metal. You only even think about these things after your entire financial engine, the pyramid, is built and running perfectly. So there you have it. We've built the pyramid from the ground up. Now, let's put it all together into a clear, simple blueprint that you can use to check your own finances, like the second this is over. Here it is, your whole financial roadmap in 6 simple steps. Number 1, destroy any debt with an interest rate over 15%. Number 2, build that 3 to 6 month emergency fund. 3, maximize all that free money from your employer. 4, invest for your medium-term goals. 5, start, and this is the most important part, sustain your long-term SIPs. And then 6, way down the road, you can exploit those accelerators. That's the order. That's the plan. Don't skip a step. And that really brings us to the final and most important question. Just take a second and be really honest with yourself. Looking at this pyramid, which step are you truly on right now? And hey, it is totally okay if you thought you were on step 5, but you realize you're actually on step 1. Most people are. But the great news is, now you know exactly what to do about it. The difference between financial stress and financial freedom isn't being a genius. It's having a system and the discipline to follow it. Your journey starts now.